Every single business on the planet has to deal with an uncertain future. But what happens when that uncertainty isn't just a vague worry, but a potential cost, a huge one? How do you actually put a number on something that might or might not happen? And that's exactly what we're going to break down today.
So just imagine this for a second. Your company's operations have been linked to some environmental damage, and now a whole community is taking you to court. They want millions in compensation. This legal fight could drag on for years, and who knows how it's going to end.
And this leads to the big question, right? What do? Do you just cross your fingers and wait? Do you kind of ignore it until a judge bangs a gavel and gives you a final number? Or do you have to somehow reflect this massive, uncertain obligation on your financial statements right now?
Well, for any company that follows international financial reporting standards, the answer comes from a very specific rulebook, IAS 37. You can think of it as the official guide for these messy situations. It's designed to make sure a company's financial reports aren't hiding any potential future bombshells from investors. So in this explainer, we're going to walk through exactly how IAS 37 works. We'll start with the basics, then get into that critical decision. Is it a provision or is it a contingency? We'll look at how you even put a price tag on uncertainty, see the actual accounting entries in action, and then wrap up with some tricky edge cases and the key takeaways you need to remember. All right, let's dive in. The whole point of IAS 37, the big idea, is to make sure these uncertain potential future payments are recognized and measured the right way. It's all about giving a true and fair picture of a company's financial health. It's about accountability. Now, to get this, we have to start with the absolute foundation, the definition of a liability. And what's really important here are two phrases, present obligation and past events. This means the company has to be on the hook right now because of something that has already happened. Just planning to do something in the future, that doesn't count. And that leads us perfectly to our next piece of the puzzle. A provision is just a special kind of liability. It ticks all the boxes of a liability, but it comes with a catch. We're not totally sure when we'll have to pay or exactly how much the final bill is going to be. It's that uncertainty that makes it a provision. Okay, this is where the rubber meets the road. This is the heart of IAS 37, making the call. Does this uncertain cost get put on the financial statements, hitting your profits in your balance sheet, or is it something you just mentioned in the footnotes? And the decision really boils down to probability. If paying out cash is probable, and in accounting terms that means more likely than not, a greater than 50% chance, you have to recognize a provision right there on the balance sheet. But if it's only possible, less than a 50% chance, or you just can't measure it reliably, it's called a contingent liability. You don't record it, but you absolutely have to disclose it in the notes, no hiding. So, to make it official, there's a strict three-part test. A company has to be able to tick all three of these boxes. You need a present obligation from something that already happened. The payment has to be probable, and you have to be able to make a reliable estimate of the cost. If you fail even one of these, you can't record a provision. It's an all-or-nothing checklist. Okay, so we've been talking about having to pay money out, but what about the flip side? What if your company is the one doing the suing, and you might get a big payout? How does accounting handle uncertain gains? Well, that's called the contingent asset, and this is where accounting gets really conservative. You do not recognize it on your books. Why? Well, it's to avoid the big risk of booking income that might never actually show up. You only disclose it in the notes, and only if the cash inflow is probable. You wait until that income is virtually certain before you actually recognize it. All right, so we've gone through the checklist, and we've decided a provision is definitely needed. Now for the really tricky part. How much should it be? We already know the amount is uncertain, so how in the world do we come up with a solid number? The guiding principle here is what's called the best estimate. This is basically the amount a company would rationally pay to either settle the problem right now or transfer it to someone else. It's not a wild guess. It's based on management's judgment, past experience, and sometimes even reports from outside experts. Now here's a really cool example of how that best estimate is calculated. For things like product warranties, where there are a ton of items involved, use a statistical method called expected value. You look at every possible outcome and weigh it by its probability. So here, you can see that even though a major defect is pretty rare, only a 5% chance, the cost is so high that it still contributes a huge chunk to the total. The best estimate for our warranty provision here is $400,000. But what if the payment isn't due for years and years? Well, there's the whole time value of money concept. $1 million today is worth way more than $1 million in 10 years.
So IAS 37 says if that effect is significant, you have to discount that future payment back to what it's worth today, its present value.
Okay, enough theory. Let's get our hands dirty and see what this actually looks like in a company's books. We're going to walk through the journal entries for a long-term provision, something like a company being required to clean up a piece of land a decade from now. So first up, the initial recognition. The company calculates the present value of that future cleanup cost. Let's say it's $463,194. They credit the provision account, which creates the liability. But look at the debit. This is the interesting part. It doesn't hit their profits. It actually gets added to the value of the asset, the property, plant, and equipment. Okay, so each year that passes, we get 1 year closer to the settlement date. And as time ticks by, the present value of that liability grows. We call this unwinding the discount. That increase is recognized as an interest expense, which hits the profit and loss statement, and it makes the provision balance bigger. It's basically the cost of time.
And finally, the day of reckoning arrives. When it's time to actually pay for the cleanup, the company makes the cash payment. The journal entry is pretty straightforward. You clear that provision right off the books, and the cash goes out the door. The liability that's been building up for years is now finally settled.
The basic rules cover a lot of ground, but IAS 37 also gives us guidance on some specific and often really tricky situations. Let's take a quick look at a few of those right now. First, you have onerous contracts. This is when you're locked into a deal where the costs to fulfill it are guaranteed to be higher than what you'll get out of it. You have to book a provision for that unavoidable loss. Then there's restructuring. You can only provide for things like layoffs when you have a detailed formal plan and you've actually announced it, creating a real expectation. And this last one is a big one. You can never, ever make a provision just because you think you're going to lose money in the future. There's no past event there, so no provision. All right, let's boil this all down. Here are the key things to remember. A provision is a liability, but with uncertain timing or amount. You only recognize it if it passes that strict three-part test: present obligation, probable outflow, and reliable estimate. If not, you disclose it as a contingent liability. You always measure it at its best estimate, and you discount it to present value if time is a big factor. At the end of the day, IAS 37 is a critical tool that makes sure financial statements shine a light on the real risks a company is facing. And that leaves us with a final thought, doesn't it? We often think of accounting as this world of precise, concrete numbers. But as IAS 37 shows us, so much of it is also the art of estimation. It really makes you wonder, given all these rules, how much of what we see in a company's financial reality is truly built on a structured best estimate of what's to come?